If you think real estate is passive, then you've already told me you're either new, undereducated, or lying to yourself. But the great part is, while work isn't passive, the tax savings absolutely can be. Today we're breaking down how smart real estate professionals actually keep their money and not just earn more of it. Welcome back to Spicy Takes and Tax Breaks. I'm Aubree Denekamp, your tax strategist, write-off queen, and the one reminding you that your business decisions do have tax consequences. And today we're breaking down exactly how that works, how it saves people tens and sometimes even hundreds of thousands of dollars, and how I see people screw it up every single tax season. Joining today is someone who actually understands the world from the inside out. Not just selling property, but understanding positioning, leveraging, and how to use that in a long-term strategy. Phil Sexton, he is a longtime residential real estate leader in the Valley, and he actually knows how agents and investors scale, or they don't. Phil, welcome. Happy to have you on today.
Thank you. What a wonderful intro. Aubree, we set the stage here. We got big shoes to fill now.
Yes, we do. And I'm excited to have you on, hear everything about what everyone else wants to know. So really hear what I hear every day on my end, and I'm curious if you do on yours too, is that most people think the goal in real estate is more deals. It's more commissions, you're making more money, more doors opening, more doors knocked on. Is that kind of your take and your experience?
You know, that's a loaded question. So there's some people that like volume, that like transactional volume, and that's their goal. Obviously, it's easy to say that's just not the only variable in real estate. I think that when you're younger in the business, your goal is let me do more deals so that I can figure out how to do more deals. Like I want more stuff thrown at me faster so that I can get better quicker. And then once you've kind of been in the business for a while, a lot of times the agents then start to turn their focus on how can I increase my average sales price so that I can do more deals, but make the same, I can do less deals, but make the same amount of money or more money. And so that's why I say it's a loaded question. No, more transactions, yes is always good, but higher prices is also good. Or even what we're seeing a lot more these days since some of the commission rules have changed is bringing a different level of service that comes with a different fee that agents charge or commission that agents charge.
Yeah, and I think that's a really good point in any business, but specifically in buying a home or what your next future is going to be, whether investment or living in, is that you do want to take that and have it on a personal level versus just something stressful. So I think it's a really good way to look at it. But with that, the more money you make, the more taxes you have too. And I think that's a lot of things that most businesses don't know, but specifically in real estate, people don't really think about. You do want more money, more commission coming in, but what are you doing to mitigate that or shift that on your own end? Is that something that you focus on or do on your own personal time, or is that something that you kind of advise other agents on?
In our pre-call to this podcast, I told you how much this topic that you have invited me in here to talk about is requested by agents. And there's not a ton of content out there on what agents should be doing in order to keep more of the revenue that they earn. And not just from a budgeting and marketing and expense management standpoint, but even on the tax strategy standpoint. And so, like, do we have to get a car over the 5,500 pound limit? Or does it help us as a real estate professional to have multiple investment properties? Where are the red flags that we can avoid? Where's the Airbnb that we don't use too much? Like, there's so much that we can do in this business that is a little bit in the dark for a lot of us, that I'm excited to be on here and chat with you more, Aubree, just so that I can learn and figure out more ways to do it. So yes, I encourage realtors that are on our team and audiences of some classes that I teach to educate themselves on this topic, but more so I encourage them to reach out to people like you that are the expert in that and let you know the rules so that you can advise them what the best way is to manage, how to keep more of their money rather than send it to Uncle Sam.
Yes, well said. And I appreciate that compliment. And that is a really good point. And I think it's misleading. You can watch so many different things on TikTok or Instagram or even search ChatGPT in Google. And the thing is the rules are evolving year after year. There are new statutes put in place all the time. There's the big, beautiful bill that just came out, all of that. But there's also misconceptions. Like one of the big ones I hear specifically in real estate is, hey, I'm starting to not get a W-2 now. I have commission coming in. I'm 1099. So I got an LLC and this is this magic tax trick. But really, it's just a legal wrapper. An LLC is great. I highly recommend it for everyone out there, but it's not a tax strategy in any way. There's no additional deductions to be taken versus just as a sole proprietor in 1099. So the big goal here is for anyone, whether you're in real estate or if you are in any other business, is it's how your income is going to look on a tax return. So that $500,000 worth of income you're having come in, it can be shifted through W-2, it could be 1099, it could be sole proprietor, it could be through an S corp, a C corp, it could be on self-employment, it could be through a rental property. But basically, we want to shift each income into a category that keeps you under certain percentages of what that's going to be taxed at, and that's kind of where the strategy comes into place. But for realtors, one of the easiest things is when you're going to go from that LLC point to an S corp, and that's typically when you're hitting over $50,000, $60,000 in net profit. That means after all of your deductions and expenses. So it's one of the big things that just is a form you submit and changes. You do have to make yourself on a payroll. So that's an easy thing you can set up, and you can do it end of year, or you can pay yourself, quarterly, monthly, however that looks based on what you're making. But that income flowing in is based on how it's going to be taxed. Whatever categorization you're putting it in for income is kind of how you would categorize a deduction if you think of it in that way. But it's definitely one of the things that also helps it make it easier. And I'm sure you see this a lot when you're buying a home. You have to have some sort of income or revenue coming in to be able to qualify for certain mortgages and things like that.
Yeah. The self-employed people are often the harder ones to get a loan because what they make on paper is sometimes different than the reality of their lifestyle. And I mean, obviously there's workarounds for that. Rachel, I think we both have a friend, Rachel Drummond, who works with Bison Ventures at VIP Mortgage, and she's one that knows about how to make those deals still work and how to get financing for them. But yeah, it's there's some repercussions that people need to consider in showing that they make no money in order to pay no taxes, and that sometimes comes with benefits that you get by showing that you do make money, aka being able to get
Absolutely.
credit.
Yeah, it's such an unfortunate double-sorted edge on that one. I mean, I personally try to write off absolutely everything I can in the world, but that does make your lending power a little bit less, which again, that's where the planning comes in.
We just had a
So,
buyer. We just had a buyer
yeah.
who was self-employed, and he was in the car business, and he actually has a couple of vehicles that he's going to be running through Barrett Jackson this year. But he, on paper, it was a struggle to get him qualified. And part of the solution that was offered, or one of the solutions that was offered, was, why don't you file your last year taxes on January 1st, as soon as this year turns over, file those taxes immediately so that we can have a newer tax return, and then that old one drops off so that you can, yes, pay more tax so that you can then qualify for this loan. And it's just silly that it's that way.
It really is, but it's powerful what you can do. Like what one day in a year can make a difference, but also filing that return, getting it done, which I believe business returns you can start filing next Tuesday. So actually the day that this is going to air, but that says everyone comes to the table with something different, but that's why you need an experienced realtor who can put you in touch with that lender and work around so you can go off statements or off a prior year tax return versus the overall picture. And I think that's incredible. Do you see one of the big things people come to me with is they get things on social media or they've been stuck scrolling into TikTok and they come up with like the craziest deductions or ideas. And I'm like, we can do that, but you're definitely going to get audited. Is that something that you fall into the trap of yourself? Because I know I do. I mean, I end up Googling or scrolling a little bit too deep on things, but it's misleading sometimes.
I am pretty confident that I have no idea how to do my taxes. And so I try not to take bait. I would rather send you the clip that I saw and say, is this something, is this real? And then you be the researcher to then come back to me and say, that's not real, or yes, that is real. And here's how you should take advantage of it. I know what I don't know what I don't know, but I definitely know I don't know tax strategy and tax law, and especially how much they change. And so, no, I try not to fall into those traps, but I certainly see some of the things and I'm like, oh, that sounds interesting. Is this real or not? But for me, one of the ones that's really big for me, and maybe we can have you can comment on this, is that because when it comes to realtors, that earn a living from selling residential real estate, that industry is very broad in what kind of deductions can go against your earned income. And so, like, I've always encouraged team members to acquire rental properties because the rental property, the depreciation on rental properties, if I'm not mistaken, it can be like a dollar for dollar reduction of your taxable income. Am I saying that right? I don't even know if I'm saying that right.
You are and you aren't. It depends on what that taxable income is. But in the other end of that, yes, you can almost dollar for dollar. So this property that you purchase is accruing and growing in what its worth is year after year, but you're able to continue even after that initial purchase. It's called cost segregation. Basically, you come out and get an evaluation on your property. It costs between $2,000 and $4,000 to the owner, but now you have an actual depreciation schedule that can be done on your tax return. You can accelerate it right now, but basically, you can claim the same person who could claim $4,000 on a rental could now claim $196,000 on that rental against their income within the year. And that is a huge, huge benefit. You do the one evaluation and then forever that depreciation continues. Similar to if, for anyone out here who's not real estate, if you were to purchase a vehicle and you were to accelerate the depreciation on that vehicle, so you're taking the full deduction of the vehicle in 1 year versus what a mortgage of 30 would be, or in a car sense, 5. What you're doing is you're accelerating that depreciation within 5 years with that cost segregation study. And so depending on the value of the house is kind of what that amount being able to be deducted year after year is going to be, but you're getting depreciation taken off of the taxable income that you're earning in that year while your value of the property is likely going up year after year too. So that is incredible to be able to do that. And yes, I recommend every single person do that. What's interesting though, Phil, is a lot of people actually have properties like this and they don't claim any depreciation at all, not even over 20 years, which is the standard for if you don't do a cost segregation study. It's a 20-year depreciation schedule typically on a home. But even that, most people don't even claim it. They have all of these credits and deductions that could be there and be saving them hundreds of thousands in a lot of cases per year, and they're just underutilized. But yes, that is a great, great asset. Even rental properties, though, I mean, you can be deducting everything that is going into the rental property. If you are taking flights there to check in on your property or meet with a new resident who's going to be coming in, I mean, there's so many opportunities that are there for something that potentially people are already doing.
Yeah, so I need to buy a rental property in Hawaii, is what you're telling me.
I am, yes, and you should also stay there. Make sure everything's working well.
Yeah, exactly.
Which island are you going to?
Yeah, I don't care any of them. I just need to be able to deduct my ticket to go check on my property.
Yes, I love it. But
No,
yes, that would absolutely qualify for that. Like any time that you'd be going back even to check on it or restock it or anything like that, that then makes it a business expense and also a valid trip to be going there.
okay, so then here's the real question, which we kind of went back and forth on prior to this, is where's the line on if I am going to take a trip? Let's say that I'm going over to San Diego and I'm staying at a hotel over there to do some market research. I want to
Yes.
understand what the real estate agents are doing in San Diego so that I can make sure that I'm up to speed on any clients that I have that are moving here from San Diego. Is that a
It's a great
deductible
question.
trip?
Yes and no. So there are rules around this. Market research is the one that I stray my clients away from using. I'm like, don't use that word. Even if it's market research, that could be considered a lot of different things. So I actually worked for an electrical company about 10 years ago, and one of my bonuses was always to find a lighting conference to go to. It could be anywhere, which come to find out there are millions of lighting conferences in the Bahamas, in the Caribbean, all of these different places that were pretty fun. That said, why that was even given to me back then as an employee, and I was a W-2 employee at the time, is because I was flying out there. So 1 day of flying out there, that is considered business because you're getting there. While I was there, I did 2 days of a convention, which was 3 hours each of those days. I also did a photo shoot for the company while I was there during those 2 days. I then spent 2 days doing all Aubree related things. And then I flew home, which is business, on the next day. So during that 5-day trip, the 2 days that I went to those couple hour conferences on were business. The 2 flying days were business, 6-day trip. And then the 2 days that I just went and explored the town and did whatever I was doing, that makes it a business trip. So the hotel room, the flight, all of the things encompassing in that were equal to business. Let's bring it back to the San Diego trip. So in San Diego, if you were driving there, the day of driving there is business. If you're flying there, same thing. When you get there, I would recommend finding a networking conference to go to, whether it is BNI or you're finding a realtor conference that you're going to, any of those things. If you are meeting with a potential prospective client, or if you look at a prospective office there, or meet with a realtor to actually connect and go through different ideas or strategize. Yes, any of those things would be considered business. But the rule of thumb for like your hotel, your flight, any of those expenses is if they're not going to be split as far as like half the flight is now under Phil and half the flight is under the business, it would have to just be that more than 50% of it is constituted as business. That means 1 time per day you are doing a business activity, and keep in mind both days of travel are considered business. My daughter and I, she's an employee of mine, her and I do a lot of trips, not for market research, but potentially meeting with a client or doing different networking things. We do a lot of branding and marketing in the sense of taking photos. We get a photographer to come with us, not with us, but we schedule something wherever we're at. But in that sense, that all makes it a business write-off as well for both her and I.
Nice. See,
Yes.
knowing the battle.
That's
Wasn't that G.I. Joe? Like, there was some old cartoon, knowing the battle is half. I don't know. Knowing is half the
yeah,
battle.
knowing it is half the battle. Yes. And it
Nice.
really is with most things.
Yes. So the other side of your business, because you are not just on tax strategy, but you also do bookkeeping. And so how much do you assist with like cash flow management and predictions and forecasting and things like that?
A ton. I think that is half of the battle, actually. I think bookkeeping is so underrated, and I get it. It's one of the most boring things to actually converse about. But in the sense of what it is doing, it's creating the actual map that now you get to create the plan or the route in. If you don't know what those margins are, if you don't know what you think you're going to be at the end of the year, you can't budget for that. You can't create a tax plan around that. You don't know if you should be buying a property or a new vehicle before year end. There's nothing that can actually be created. You can spend a lot of money and pray it slaps when the end of the year is happened. But at the end of the day, like we want to know where you're at. Again, for us, a big part of bookkeeping is, hey, where you're at right now, but also where do you want to go? A big one that we ask all of our clients is, what do you want to buy in the next 5 years? Because whether it's a commercial property or a house, what that taxable income is so, so important, as we said before. Bigger than that too is there's no plan, you're guessing. Like people come to me all the time and they're like, I just hired a new marketing agent and it's for, 10K a month. And I'm like, you're struggling so bad. They're like, it's going to bring us in new business. But at the end of the day, like if you don't have 10K to spend, you're kind of beating a dead horse at the end of the day too. So there's things that need to be done. So from the bookkeeping standpoint, understanding your books, that's how you become. So having that record is how you then create the forecast, how you create KPIs and see what's actually making you the money and what's just expending it. So I think bookkeeping, and I know real estate a lot of times because you don't have a team, a lot of agents are solo, or maybe they have a VA or a 1099 underneath them. They don't think it's needed and it seems expensive. Even if it's just a couple $100 or a $50 QuickBooks fee, I totally get that. I'm like, do we have to? I understand like the quarrel there, but it is so, so important to have.
It's just so interesting how seasonal this business can be as well, right? Where what you're able to do, historically, we always had very good fourth quarters and second quarters. Fourth quarters because people would come in the wintertime because we are the Valley of the Sun. Third quarter, that's when people are going back to school and there's just not as much action. And so that spring season and that winter season were historically always our favorites and or most profitable. But now with this, we've kind of been in a little bit of a slump for the last few years, ever since, the COVID boom kind of busted. 3 years we've had historically low home sales across the entire country, and everybody at the turn of every year is optimistic that we're going to get back to some normal levels. I think that first in, first out is where my optimism comes from. Is real estate, I think, took a hit, kind of went into a recession, real estate recession that we had. 3 years ago. And so we've been in this lull for a while, and we're kind of waiting, because if the economy, if the overall country goes into a recession, then it seems like they use real estate to help pull us back out. And so there's a lot of us that have adjusted cash, that have adjusted expenses and have adjusted their budgeting, because you want to be able to make it through. And
Yeah.
you want to be able to stand there at the other side with your flag saying, look, I'm the one that made it through these downturns. Like, this is the tough time where people are getting out of the business that aren't serious about it, and I've made it. And being able to forecast your numbers and budget accordingly is a big reason on how you can do that. Is a big way on how you can do that.
It
So,
is, and that's a really good point too. I think a lot of people don't look out that far, specifically when it is a market reality. You made a good point though on the government typically incentivizes us to buy properties when we start hitting that recession and that government hit. We, I believe, are kind of on our way there right now too, very close. But we kind of saw with the big beautiful bill, it came out in a bunch of different ways that could. But there's also the big debate, and I'm curious if you have an opinion on this. It's something I hear a lot about specifically online, but about, is renting cheaper right now, do you think, specifically locally, than owning in ways, or is that completely a misconception?
that is the reason why that's such a big debate, is because the it's impossible to look into the future. I think that right now, like, it's so dependent on when you buy and when you sell, and you know, I feel like I'm skirting the actual question, but it just
No, I
depends.
get it.
There's no one answer for that. And so, like, right now, we just had a buyer who closed on a property. The guy that sold the house bought it up here, and then there was a let's see, around it was around $400,000, and the seller sold it for about 50,000, so maybe 12% less than what he bought it for. And so I've got a buyer
Yep.
today that is coming in at 12% less than what the seller bought it for 3 years ago. So if you asked me that question 3 years ago and I said, "Oh no, it's cheaper to buy," well, that didn't work, because the guy sold it at a loss. But if that guy held the property for another 10 years and now that value's back up and he was able to sell it with 6 figures of appreciation on it, then my answer to you might be different, right? And so it's really less on the buy side, I feel like, than it is more on the sell side. How long are you going to own that property? What are you going to do to depreciate that property? What are you going to
Said it exactly right though. No, I want to pause you because you said that exactly right, because it's one of the big things I tell my clients is like, it's the same as the stock market in a lot of ways if you're looking at it that way. It's how long are you going to hold it? If you're using it as an investment or a strategy as an investment like we do in the stock market, we can't always with the home, but if you're thinking about it in that way, plus also what would it cost to rent for 3 years? Probably close to 50,000. So is it really a loss? Additionally, one of the last things I want people thinking about it, because it's something I'm trying to really wrap my mind around in strategies with kind of the market turning right now, is if you're using it for depreciation or for a deduction, because you are going to have to maybe take a $50,000 loss, potentially holding it or selling it. I mean, there's other strategies that can be in place with it too, but you are also getting money back in other ways by owning that home that aren't captured in in like selling it down the line. So, whether that's your home interest being deducted year after year personally, or if it is a rental property. So and to answer what my thoughts are, no one asked, but my thoughts on that are, you have to look at it, it's person by person and actually case by case. It too so much is bigger than what we're looking at in just the sale of being like, oh goodness, it's $50,000, which that is such a bummer. I would not be thrilled to do that, but it's not necessarily a $50,000 loss when you're encompassing all other things.
fair? I It's a great question. Thank you for throwing this firework into the middle of this conversation, because it's a great I think that with most rents right now have come down a little bit. But
Hmm.
if we ask anybody, do you think in 10 years rents are going to be higher or lower?
Higher.
I think most people will say rents are going to be higher, right? And so, is it cheaper to buy or rent today? Well, I guess today it could be either, depending on which product and how you're going to finance it and all that jazz. It could be either today. But let's fast forward out 10 years. And now, had you bought 10 years ago, would it be cheaper or more expensive for you today had you bought 10 years ago? And so, it's just hard when you live in such a short-term gratification. I want my immediate gratification. I want that win right now. I would rather save $100 today, right? You've seen those videos. You have a daughter. You've seen the videos of the kids
Yep.
with one marshmallow, and if you wait 5 minutes, you're going to get two marshmallows, and they eat the first
Yep.
marshmallow. Like,
They
we're all
can't,
that
yeah.
kid.
It's too
We're all
much.
that kid.
Yeah, we really are in such a different way, but I agree with that.
Yeah, I would rather.
It,
Yeah, so I'd rather if I could save myself $500 today, I would rather do that, and then I could go out and I can live a lifestyle with 500 extra dollars in my pocket, rather than prepare myself to be able to do even better 10 years down the road. That's
yeah.
a heavy. I mean, but maybe I'm speaking. Your audience is probably like typical realtor talk. Typical realtor.
No, which is why I jumped in because I actually agree. I don't do anything in realty myself, but I think it is such a powerful, powerful tool both for investing long-term savings, but also from a tax side. Like there's so much we can mitigate there. Even if you want to go rent your house out, like there's things we can still do to save overall pictures. So I think it's not just realtor talk. I think it's looking at what the situation is and where you're at, which brings me to kind of like, again, not really so much talked about, but I'm curious from your end, do you guys ever advise like when people are buying homes and stuff, like does that go into a trust? Does that go into a married couple's name? Like, do you guys facilitate that at all? That's kind of an off the wall question. I'm just curious though.
Not an off the wall question. I actually am a mentor for a group called Modern Ventures, which is a startup networking group. I don't know exactly how to call them. It's where startups go in order to kind of test products to see if there's product market fit. One of the ones that came across my plate was a company that does just this, sets up trusts and is targeting real estate agents to encourage them to have conversations with their clients. And when it came across my plate, my property, my wife and I have our homes in a trust. And when it came across my plate, it kind of shined the light on the fact that real estate agents really don't get into that conversation enough. It's not one that we have a lot of, after a deal closes or during a deal, you're always trying to give white glove service and have this amazing client experience and take care of all the things that are necessary, like the utilities, and don't forget to leave me a review, and here's the pool company and all of that jazz. But for some reason, it's not always brought up that you should be advising people on how to hold that house and how to set up what's going to happen in the event of the inevitable or the unlikely event, like what's going to happen to this property. And even though we've all heard horror stories of properties getting tied up in the legal system with the government because it went to probate and that takes forever, and you've got an heir that won't sign a doc, and now you got months that go by and the property sits and gets more dilapidated, and a trust and a will would have made that whole process so much easier. And so it's a piece that no, I don't think real estate agents talk about enough, and yes, I think that should change.
I do too. And I think part of it is that I don't think the knowledge is out there. I think a lot of real estate agents don't even have their own homes in a trust, and that's not lack of care. I think it's just not spoken about. It is something, in my opinion, that should be discussed in school, even, but like elementary, high school type of ages. But it is something that happens. I mean, if it's not in a trust, it does go to probate. Like there is all these things, and there's a lot of fees that go with that get quite expensive in the event of people not agreeing, which that's life.
Humans don't
But yeah.
like to talk about their mortality,
Yeah.
right?
Which
Like
it's
they,
hard, I get, but it's
yeah,
inevitable. It's going to happen.
it is inevitable. But what they think is even more likely is that they'll sell the house before it's inevitable. And that's the challenge, is that
Yeah.
for most people, it's a gamble. I'm going to sell this before I get hit by a bus, or you're not. You don't know.
Yeah.
And so, yeah, do I save the money from setting up a trust because I'm going to only hold it? Oh, on average, people only hold their homes for 11 years. Yeah, fair. But, at what point then? What's the trigger? I should track this in my CRM. I should say, look, 64 and a half is when people are okay to have a conversation about trusts on a regular basis. Or is it like 42 and a third? I don't know what the number is. Maybe it's when your kids,
I feel like it's life events. I was going to say life events would be, because I feel like at the hospital, they should tell you as you leave with your baby, here's what you should do. They don't, but they should. And the trust is one of them. A will, what happens to your kid if you and your husband get in a car accident? Like those things are so important. But same with real estate. I really think that's something that whoever out there is listening, real estate should get into that because it's something I think a lot of people would do, even if it's not at the time of buying it, but a year down the line, but also something to keep in contact with your clients too throughout that next year.
Yeah. And so what's funny is I had this startup come across my desk that's trying to broadcast, to real estate agents that these trusts should be formed as on a regular basis. And I thought, oh, that's cool. I'm going to start doing that. And then I met Rob, who's a friend of ours, whose
Yeah.
whole business is to set up these trusts and wills. And I thought, man, I would way rather have a personal than, a TurboTax. When it comes, I say a TurboTax, but you know what I mean. Like it's just
Yeah.
a cold conversation, and it's nice to have Rob now to say, hey, I got a guy. If you're interested, I'm happy to hook you up with him, and he can get you all set up, and he can answer all the questions, all the unknowns, and can hold your hand through it rather than filling out, a cold web form.
Yeah. Well, and the thing with the cold web forms too is there's so many things that aren't addressed. Like, hey, what about your niece? Or what about this? Are you guys married and are the kids from different relationships? Because for business, at least, I have a lot of, or I've seen over the years, a good handful of business owners who have died. And they've been married. So the whole time I've known them, their spouse was around. And the spouse is not shared with the kids. And there becomes all these discrepancies on even that how the business goes, and the business was clearly given to the spouse and all of that. But it's something I do see a lot in investments too, but also homes. I could imagine there's differences in any of that. So definitely something people should be considering when they're doing it, but also something when I buy because even that you buy a house and you have a trust, it's not then listed in there. Like there's things you just don't think about. So I think that's actually really great too.
Yeah.
Well, Phil, what else do you have for us? Any other questions today?
Oh my gosh, other questions. Shoot, now I got to go to my cheat sheet. Hold on, let me pull up my notes. Because we had a lot that we were going to cover, and the real question is, did we get to it all? Yeah,
No,
okay.
probably not. I never do.
End to with the rapid fire of write off or walk away.
Okay. Yeah, let's do it. Go for it. Rapid fire.
All right. Luxury car for showings.
Absolutely. So there's requirements on how much it needs to weigh if it's 100% written off. So if it's over 6,000 pounds, it's 100% able to be deducted in the sense of depreciation through your business, which would be even if you're an agent, just your LLC or your S Corp. If it is under that weight requirement, which most of them are, it is still able to be depreciated. It's just at a certain percent based on what the percentage you're using it is to. But every other expense is 100% still able to be a deduction. So your gas, your car washes, the mobile detailing, you need new tires, any of those things, a wrap because you're getting your agency name put on it, whatever that looks like, that is 100% deductible, even if it's not over those 6,000 pounds. And depreciation is still able to be claimed, just not at 100%.
Wait a minute. I think I've
Go
seen
for it.
your business name on your car.
It is, yes.
That strategy.
100% deducted.
That's fantastic. So welcome to my home office. This makes my whole house deductible, right? Isn't that how that works?
No, I wish it was though. We should definitely, any IRS agents who have a pull in that with the president, please let him know. But no, you absolutely should and can deduct your home office, but it's not the whole home, even if you're using part of it for business. But what you do is it's over the square footage is kind of how you get the percentage of all of your expenses for your home. Say you have a 2,000 square foot home and 400 square foot of that is your office. You would divide 400 into 2,000, you have your percentage, and you would take then all of your mortgage interest if you bought a new desk for your office, your utilities, your Netflix, if you have clients come over to sign paperwork and they like watching Netflix while they're there, that is 100% allowed to be part of those expenses. But then whatever percentage your 400 square foot is, that is what now is going to be deductible on your tax return. That goes onto your personal tax return, regardless of how you're structured. But basically what that is it's giving you a credit on your personal tax of what your liability was, or a credit back if you've already paid up your liability.
Okay, good. See,
Worth
good to know.
doing.
We got more. We got more. We already kind of mentioned this, but the real estate conferences in Cabo, that is write off or walk away.
Absolutely deductible.
Awesome.
Definitely
Next.
a write-off. Do not walk away from that.
So I'm going to throw a curveball at you because it's not on
Yeah.
our sheet. But as a real estate agent, it's important that I am a local area expert. That I have clients that are moving here from out of town. A lot of times they want to know where they should go to dinner. And so market research might be the wrong phrase to use, but I want to improve my authenticity of advice. And so I'm going to go over to the new restaurant or the new speakeasy or whatever it might be. And I'm going to take my wife with me because I don't want to just be a creeper. Is there
Be a creeper. No, don't do that.
Be a creeper. Yeah, exactly. I know. It's actually kind of like empowering when I go and sit down at a restaurant and eat by myself. I'm like, yeah, dude, this is peaceful. Wow.
Yeah.
I have 3 kids. These are my 3 kids.
Yeah.
But it's nice. Time alone is nice. So anyway, if I'm going and looking at one of these new establishments in an effort to be able to talk about it authentically to potential clients, is that a write-off or is that a walk away?
So what constitutes as a business meal here would be you and one other person. So you cannot go and be a creeper. You do have to have one other person for a business meal. But that business meal is you and one other person. They could be someone who's in real estate with you. It could be a client. It could be a prospective client. It could be your wife, your kids. It could be any person in the world. But you are talking about business during that meal at some point, or drinks, or whatever it is that you're out to do. So that has to be you, one other person talking about strategy. So in the example you gave, if it's you and your wife going out to the new speakeasy, just be making sure you're talking about how that's going to work in your thing. So you're paying attention. If you see that you guys love the service, like you're making a note that that's going to be in your whatever portfolio when you talk to the next client, that is 100% a business write-off then. If you guys are going and you black out drunk while you're there and you forget to write it in your little notebook and you don't speak about business, it's going to be hard to prove that it still wasn't a business meal unless it's all recorded, but that would not qualify as a business meal if you want to think about it that way.
Don't write off the blackouts. Noted.
Remember to write it down first.
Yeah, exactly. Personal tracker. Yes. Filming content and listing.
Absolutely. All of that is a write-off. So I watch a few realtors online and they get you sucked in because you're watching them film basically their personal life. But one of my favorites is a lot of my clients double their marketing for themselves and branding themselves as a realtor is also doubled with their family pictures or their trip vacation pictures or whatever that is. But yes, 100% write-off whether it is being combined with your personal or not.
Even for the clothes that they bought to do it?
So that's a great question. Yes, but the IRS code says that those clothes can only be worn during the shoots or business, whatever. So they're exclusive. Similar to your home, it's exclusive area. So clothing, even hair extensions, because a lot of people do want to have hair extensions off, which there are many ways to do that. But for a photo shoot as a realtor, those extensions would have the expectation to be taken out after, or only a percentage would be for business.
Got it.
I like that question though.
Yeah, solid. Well, dude, it's just real world, right? This is real world.
Yeah.
And even like I've got friends. I have a friend that just went to a conference in San Diego and she was like, "Oh gosh, I got to go shopping." And of course, in my mind, I'm thinking, "All right, well, you're really only going shopping because you want to get more, update your wardrobe and make sure that you appear the way that you want to, your brand, in line with your brand when you're there." And so that's certainly a business reason. I just didn't know what the rule was, but so thank you for articulating that.
Well, and that's a great thing. So I decided I like to wear workout clothes for work when I became my own business owner. And so I decided I wanted to get a bunch of Lululemon clothes. And how I made those uniforms for my business is I got AV Accounting logoed very small somewhere on each of the pieces. That made both obviously like the logo and all of that, the embroidery fully deductible, but so was 100% of the Lululemon clothes I got. Because even if I was wearing them not at a business meeting and say I was at the gym, I was still advertising my business. So it's still 100% a write-off in that case too.
Nice. Tax strategy.
Right? But that's the kind of the whole point. Like, it's so expensive. Every single thing is taxed. You have income tax, you have state tax, you have death tax, you have sales tax, you have, every single thing in the world. You get taxed if you sell something, you get taxed if you build something, everything is taxed. but there are a million legal ways to however much it is, whether you have money to expend or you're just reworking how your personal life is already working with your business and X, Y, and Z. It's incredible what can be done. Well, Phil, I think that's it for now. I really appreciate it. And anyone else who has questions here, please feel free to reach out to Phil or DM me real estate, and we'd love to chat with you. Anything else before we get off here, Phil? Any takeaways?
No takeaways. Thank you is my takeaway. I appreciate it. It was a fun conversation, and I will see you next week.
Yeah, I'll see you next week. Have a good one, everyone.